Okay, guys, so let's go ahead and get started with talking about our prepayments. So as you guys could see, that's going to be the focus for today's webinar topic. The first thing that we want to take a look at is what types of prepayments are typically taken, especially on the accounts receivable side. Usually we see this in one of two forms, and we'll go through both of those in QuickBooks so that you guys can actually see what the transaction entry type looks like, as well as how that impacts reporting and what kind of QC or reconciliation process we can use to help ensure that we're tracking who has made a prepayment and how that should apply back to their overall invoice balance. The first way that we see is by just simply entering a payment against a customer name. If we're in here in QuickBooks, whenever you are receiving a payment, you can come in here to your Customers tab and choose to enter a payment. Most often, you would see the list of invoices available to create a payment against. If I'm entering a payment for a new customer, for Sally Smith, let's say, we don't have an invoice in the system yet, but we have been prepaid for services. So what we can do is I can choose to input a payment amount, and that is going to sit on the customer's account as an available credit. So what this does is if I put in a dollar value of $500, you can see QuickBooks gives me the option to leave this as a credit to be used later. Now, how is that going to look when we are running an aging report? If I go ahead and save this transaction, QuickBooks again is going to give a warning regarding having a payment entered without an invoice present. I'm going to click OK to recognize that it is going to create an overpayment or a credit on their account until I input an invoice later that I can apply the payment to. If I come in here and I run my AR aging report now, we'll be able to see that customer name with a credit or negative value on our AR aging report. Now, what this does is if I come down here and I look at my Sally Smith customer, I will be able to see that negative value listed here. So this will show on the report in my aging columns as an available credit until I'm ready to input an invoice that I can then offset this payment to. This is not the recommended method because what we tend to see happen is invoices will get entered, but the payments don't become applied, and we'll see that these transactions end up staying as outstanding on our customer invoice report. I want to go ahead and enter an invoice so that you guys can see what I mean and why we would prefer going through the alternative that I'll talk about in a second, which is setting up a liability account that we push those prepaids through. If I come in here and I now enter an invoice for Sally Smith, I can input a dollar value as I would for my normal invoice. I can choose an item and I can go ahead and put in my dollar value. Now what happens is when I go to save this, QuickBooks will let me know that I need to input the correct information, but once I've done that, you can see on the right-hand side here, I have a payment that's showing as available to apply it to. If I don't tell QuickBooks that I want to apply this payment, this invoice will stay open. It won't impact my report. My AR aging report will still have offsets, so the report balance will be correct, but when I run any kind of open balance report to see open invoices, that list is going to become ever growing if these invoices don't get the customer payments applied to them. So again, while this might be the quicker option to just go ahead and do that payment receipt entry on the front end and then go in and do an invoice later, if we're not doing that final step to make sure that we apply that credit information and close out the invoice, that can create issues with our overall reporting. Because of that, the recommended way that we would want to go through and choose to record a prepayment is through a liability account. Now, I know that might seem a little odd considering accounts receivable flows through an asset account. However, when we are taking a prepayment from a customer, we are saying that they have provided cash to us and we owe them either goods and or services, so some sort of service or product and material in some fashion. So it's something that we owe to them, which is a liability that we have to pay back because they have provided that money up front. So I want to go ahead and walk through what that process looks like to set up a prepaid account, record a prepayment, and then go through that reconciliation process. One of the things that's really nice is that you'll notice these functions or processes can be mirrored on the accounts payable side, just with an other current asset account instead. So be thinking of that, especially for any of our clients who get prepaid for inventory. This is a great way to be able to record that to make sure that our inventory doesn't become overstated. But before we talk through that, let's go ahead and look at how we do that setup for prepayment on the accounts receivable side. The first thing we want to take a look at is inputting an account on our chart of accounts for those customer prepaids. Like I said, that's going to be an other current liability account. So I'm going to come in here and say new, and I will choose for my account type, other current liability. Typically, we like to name it things like customer prepaid, prepayment deposits, something easily recognizable and helpful to note that it is specific to our customer account. We don't want it getting mixed in with any kind of internal overhead expenses that we do prepayments for. So I will go ahead and create a customer prepayment account and then go ahead and say save. Once this account is created, the next step that we need to go through is create an item that is mapped to this account. This piece is very important because without that item, we can't enter that prepayment invoice to make a payment against. So the next thing I will do is I will come in here to my item list and I will add an other charge type item. The reason it's not falling into any of these other categories is because it's just an internal miscellaneous item that is going to be used solely for prepayment recognition. So I'm going to go ahead and say other charge. And I will again name it as customer prepayments. This is not an item that we would be printing on an invoice unless it's something our customer needs. So the item naming convention as well as the description shouldn't have an impact on setup. This should really just be more for internal tracking purposes. So again, I'm going to call my item customer prepayments, make it consistent across the board so that we can easily go back to that item or to the account for tracking. And then again, I want to make sure that I'm mapping it to my customer prepayment account. Once I've done that, I can go ahead and say save. Now, the next step here is where we will work to enter an invoice using that customer prepayment amount. So I am going to come in here and create an invoice. And I'm going to use that customer prepayments item code. Now here, what ends up happening is I didn't code that item to a revenue account because work hasn't been performed or any kind of service or good has not been provided yet. So there isn't any revenue to be recognized. This is simply to create recognition for the cash received in. Therefore, we have something owed back to our customer. I will input a dollar value. And then once I've input this invoice, this can be paid as a normal invoice. So that is to recognize the cash received in from the customer. I will go ahead and say save. And then I can receive my payment as normal, which will work to close out the invoice. That piece is very important. We don't want the invoice to stay open. We want to make sure we receive a payment against it to close out that invoice and recognize the cash that was brought in. So once I go ahead and say save, this invoice has now been paid. It will not show on our customer balance or aging report. Where we will see the balance represented is back on that chart of accounts. If I come back here to our chart of accounts and I look at our customer prepayment account, you can see here that now I've got a $5,000 balance sitting in this account. This allows me to know that we've received in money from one or more customers that we owe something back to. Whenever you are ready to actually invoice the customer for those goods or services, we will reference using this item again to back out that prepaid value. So what I mean by that is if I come in here and I want to enter a customer invoice, I can do so. I can create a new invoice for my customer. And once I've input my item information here, I can go ahead and choose the information that I want to input. And after I've put in all of the details, the last step that I need to make sure I include is inputting that customer deposit item with a negative on the invoice. I can do that here by choosing my prepaid item again, and rather than putting in a positive like I did on my first invoice, I'm going to go ahead and put in a negative here. What this is going to work to do is deduct the prepayment value we already received from the customer so that the final invoice total shows as correct. They paid us $5,000 up front. Their total invoice was $10,000. Once we deduct that $5,000 prepayment value, the amount owed is only $5,000. I'm going to go ahead and say save and close, and that's going to allow the true invoice amount to be reflected on our customer balance report and our AR aging. Now again, here's the important step that we always want to circle back to. Everything should be referencing this customer prepayment account. So as we can see here, now that I've done the second step of entering the actual invoice for my customer and backing out that prepayment value, this account has gone down to zero. What we can do with this account to help ensure we're keeping track of who we've received prepayments from and who we've done final invoices for is through a reconciliation process. If I come in here to banking and reconcile, I can choose this prepayment account. The ending balance should always be zero. It's not going to be an account that we get any kind of statement for. We should always have a debit and a credit that offset whenever we are completing a customer order. And this will help us ensure that we know what is outstanding to our customers still. So if I go ahead and say continue here, you can see I've got my Sally Smith invoice here on the right-hand side for $5,000. That is going to be my credit or back out from the true invoice. And then the debit was that initial prepayment. So I can come in here and check these off and say reconcile, and that is going to keep my balance at zero. And anything on one side of this equation will let us know where we stand with the customer. So for example, if we had an additional debit listed here for a different customer, that would indicate to us that we've received a prepayment for them, but we haven't actually invoiced them yet. So there are still outstanding goods or services that need to be provided to that customer. This reconciliation is extremely important to help ensure that we're not losing track of owed balances to our customers. I can go ahead and say reconcile now. And then the nice thing with doing this is that it will help ensure as you're going through and doing a review of this account on a regular basis, you can see just what is unclear to help identify what is outstanding. Now with that, one of the things that's really nice is that these same principles will apply to our vendor payables as well. So if we look at the ideas of how to take prepayments on the accounts payable side, those functionalities are going to be the same across the board. But like I said, that second option of using a liability account is now going to be a bit different. that would actually flow through an asset account. So to recap, that first option, whenever we are talking about taking a prepayment for accounts receivable or accounts payable, the simple but not necessarily preferred method is to go through and create a payment that will sit as outstanding on that customer or vendor account until we input that invoice or bill that we can apply that payment to. It's going to show as a negative on the AR aging or AP aging report until we do that invoice or bill entry. And then the main thing to note is we want to make sure that we are reconnecting that payment to the invoice or bill so that those transactions get closed out and we don't see them sitting as open or outstanding on our bill reports. Now, the second way, which is the preferred method, is to go through and do that liability setup. Again, when we're talking about the accounts payable side, the only difference is that rather than it being an other current liability account, we would now set up an other current asset account. Similar idea applies in that if we have prepaid our vendors, we are owed something from them in the form of goods or services, just like we said we would owe our customer if they've prepaid us for something. So that would be the only difference with that process. Otherwise, the entry would look very similar. We would go through and input a vendor bill with that prepaid amount. Again, we want to make sure we set up an other current asset account and map an item to that account. Once we've entered that prepaid bill and paid it, at the time of getting the final vendor bill, we would want to make sure we back out that prepaid amount. And again, we would be able to do a reconciliation of that other current asset account at that time. So same exact idea applies. We're just switching some of the transaction types being used. And then again, making sure for customer prepayments, we're flowing through an other current liability account. For vendor prepayments, we're flowing through an other current asset account. Now, one of the additional ways on the vendor side that I had mentioned on the front end where we can look at being able to take what would be considered a prepayment is if we are using enhanced inventory receiving. This was a specialty inventory feature that we looked at a little bit earlier in our webinar series. And what this feature ultimately does is it creates a separation between inventory receiving and accounts payable management. The natural workflow for QuickBooks is to enter a purchase order, create an item receipt when you've received quantity in, and then have that item receipt transition to a bill once you're ready to pay your vendor. With enhanced inventory receiving, we have the capability to say item receipts solely impact inventory quantity on hand, and accounts payable is only impacted by vendor bills. So what I mean by that is normally without that feature, if we were to input a vendor bill, when we use our inventory items on that bill, that increases our inventory quantities. With enhanced inventory receiving, we are only impacting accounts payable with that vendor bill. So if we are receiving in any kind of inventory separate from when we are billed for it, we can utilize that feature to enter a bill as normal to show the items or materials that we have paid for up front. So that is a nice alternative. If we have use of that feature happening in our QuickBooks file, we don't necessarily have to use that workflow of pushing through an other current asset account. You can utilize that function to enter vendor bills to show prepayments made for any kind of inventory without overstating our inventory quantity on hand. Now, the last thing I want to take a look at is prepayments for overhead or internal expenses. For these, again, the examples I gave would be rent, insurance, anything that we are paying for up front, we have the capability to go through a similar prepayment process. In this example, I went through the idea of doing a prepaid rent. For you guys, I won't bother going through that complete account setup. We saw exactly how we can set up those other current assets or other current liabilities when we looked at the prepayment process for AR. It's going to be identical here, but the overall workflow we'd be able to use to create that prepayment expense on the front end and then amortize it out is going to be a simple journal entry to initially record the payment made for that prepaid service, and then also make sure we're debiting that prepaid rent or other current asset account that we are recognizing the prepaid service for. After that, whatever the period or length is, the terms that are established for that prepaid service, we would create monthly, quarterly, annual journal entries to continue to debit the expense account side to recognize what the overhead cost is to the company, while crediting that other current asset prepaid account. And that will take us through an amortized schedule of that particular service. So again, we've got two recordings that would happen. The first one is to record the initial payment made for that prepaid service. The second subsequent recordings are all going to flow through a journal entry and will continue to credit that expense account as well as amortize out that prepaid service. One of the things you can even look at doing with that is creating a memorized transaction. If we come in here to our list tab and down to memorize transaction list, you can use this function to create those ongoing journal entries to record that amortized expense. The alternative you can also use, which is nice, that is available, is the quick create option. So in your company settings here, when you make a journal entry, you have the option to copy it. You can also use this function on whatever that time frame is to make those monthly, quarterly, annual journal entries. Either way will allow those same expenses to be recorded, but the memorized transaction is a helpful way to ensure that we're not forgetting to follow that amortization schedule. So again, just some QC options to help ensure that we're making those entries similar to that reconciliation process with the AR or AP. All a good way to make sure that there's a double check happening. So just to finalize the main areas of focus when we're looking at prepaids, you've got the one option to input a payment on the front end and do an attachment to a customer invoice or bill as a secondary step once those actual transactions are input. Again, making sure we're not forgetting that connecting piece to help close out those transactions. The preferred method that gives us the opportunity to go through a reconciliation is to push everything through an other current liability or other current asset account that we can input and then back out on the final invoice or bill to our customer or vendor. In addition, on the AP side, we do have that enhanced inventory receiving that allows us to show prepaid inventory if we are utilizing that feature. And then finally, whenever talking about any kind of internal overhead expenses, we've got that journal entry recording to establish the prepaid amount and then amortize out that balance and record the expense to the company. Thank you so much for the time.